Kenya Airways seeing providing nice impetus to the markets yesterday after posting that 87% surge in full-year pre-tax profit. The market clearly happy with the numbers. What are you making of the company's ability to actually sustain that kind of earning?
Thank you for having me, Alishia. I think that was really commendable. They had a lot of challenges which pertains to their industry, the most noticeable being the high fuel costs. Fortunately, as usual, they had hedged against that. We also had the shilling weakening, which again, in a way, played to their favor from their dollar-denominated revenues. And they also managed to maintain a good dividend payout policy, paying 50 cents extra. This time it's 1 shilling and 50 cents per share. Looking forward, I think they still have a lot of returns to make from the routes they added on. They added about 6 routes in the period. And I think as we move ahead, we are going to see much return on investment from these.
There are slight concerns about the pressure, on heels from rising fuel costs and then competition as well, especially where we've got the company embarking on quite expansive expansion plans. Speaking to the company's financial director yesterday, he was saying that they're busy finalizing a 10-year plan, getting that 10-year balance sheet in order, and they're looking at financing expansion either via a combination of debt or equity alone. They're not quite sure at this stage of the game. What would you like to see in terms of how the company finances its expansion plans moving forward?
Yeah, what you said is actually quite true. They still have a task ahead of balancing their expenses and making sure they don't spend too much. In their report, they said they spent quite a lot this time on wage bill. They are paying a lot of their staff. And because of the expansions, they have also had a lot of operating expenses. But maybe what I would say is they should streamline their staff. Again, maybe boost the local industry. They have been doing well in beating out the smaller players by having offers here and there, which have actually boosted their revenues locally. And maybe regionally, they still have a lot of competition. Maybe I would mention Ethiopian Airlines. But even so, I think this comes with good management strategy.
Despite still having to finalize their cash flows, interesting that they paid out that 50% higher dividend. What did you make of that move? Was it a prudent move to make at this stage of the game?
Yes, I think it was. And at the end of the day, shareholder value matters. You want to give back. We saw a similar move when Safaricom actually ate into their revenue 61% to still maintain the dividend payout. So for me, this is actually quite welcome.
Well, with certainly the Kenyan consumer under immense cost pressures at this stage of the game, but at the same time, that's kind of story holding true for the East African region as a whole. What ability does the group really have to transfer some of those costs onto the consumer? Some are questioning its pricing power in the current economic environment.
I think it boils down to a game of numbers. They have to get their management strategy right. Make sure that what they spend on marketing, what they spend on these new routes, what they spend on even the new planes is actually commensurate with what they get back. They may want to, they actually acquired some planes. They may want to hold on to that. They may want to also focus more, as I said earlier, on bolstering the local market.
Well, I didn't get a chance to chat to the FD yesterday about their fuel hedging positions because that had been their Achilles heel, with it having induced full-year losses in the 2008-2009 period. It seems to have benefited them over the last financial year. Any mention in the markets at this stage of their strategy in that regard?
I think the strategy remains the same. If I didn't see the wrong figures, they actually gained this time about 298 million from hedging. And we've seen what has happened. Fuel prices have been on the constant rise. And normally when that happens, when a company hedges, it actually pays a lower price for fuel. And I think that is working well so far. But inflation moving forward may be a big worry for them. It may be a red flag going forward.
Well, we've got that share price sitting at around about the 42 shilling mark. Some have a price target of 57 shillings in sight. What's your view?
I think that is not too far-fetched. I think even 60 shillings is quite possible. Kenya Airways seems to be one of the many undervalued stocks on the NSE, and I actually think it has that potential to move well beyond the 60 shilling mark.
Well, we've then had Uchumi Supermarkets falling the maximum daily limit of 10% yesterday to 11 shillings 25, and really that share price extending losses into a second day after its resumption of trade this week, and some would say providing indication that investors are still nervous around this company. What's your sentiment around Uchumi Supermarkets right now?
It's very okay to be nervous because it's a company that was under receivership less than 6 years ago. But then again, we've had Uchumi be in profit for the past 3 years. They have got a clean bill of health, both from the capital markets, and also the balance sheet speaks for itself. And I think what maybe put people off is when the Attorney General said that he may revisit the case, which there was a scandal behind Uchumi and why it went down. Maybe investors saw that as a red flag and backed out, because looking at yesterday's trades, demand again shifted down in favor of supply. And maybe that's why it went down 8.8%.
Fair value for the stock there in your books?
Well, I would put it more or less at the same price, maybe 12 shillings 50 cents. Or a bit lower. We have to remember they had a debenture about sometime last year, so I think trading between 12 and 14 should be its actual price.
Let's move on to Mumias Sugar. Yesterday saying that it expects better cane quality and higher factory efficiency to lift output by 6% this year. What's your view on Mumias Sugar right now, Robert?
Mumias, well, it seems to be very interesting because, first of all, their fundamentals are not bad. But then again, we look at their balance sheet, not so good. We look at the reason why they posted a decrease in profit for the period the last time. They mentioned logistics, poor transport infrastructure between the factories and the market. And all these things actually are small things which the management should mitigate. Also looking at the prospects, they have the ethanol project underway, which is very good. I think they'll get a lot from that. And maybe the sugar market, still a lot of room for growth there. In spite
a lot
of the
is still dependent
deadline.
on the weather, though, where, in the last earnings report, it was heavy rain that actually disrupted cane deliveries.
Yes, and actually that's what I was saying about the transport infrastructure. Yeah, and but I don't think that should be a problem now. We've seen the rains scattered here and there. I don't think looking forward it should be a problem.
Heading into next week, Robert, what do you have your eye on in terms of what's expected to influence trading activity for the week ahead?
Well, we still have a lot of corporate actions underway. Probably in course of the next couple of months, we've had some companies who wish to list on the stock exchange. We are still waiting for the prospectus from British American Insurance. We're still waiting for more information from TransCentury. But looking at what is already there, I would look at Cooperative Bank. They had talks of a rights issue or a bonus issue, so we may have to wait and see what they come up with.